Good afternoon. I'm going to take the liberty of introducing myself and some of the panel members here. And the good thing is the timer has not started, so I've got some extra minutes to speak. So the topic of the day is stablecoins and digital assets and how they are being used from an institutional point of view. Obviously, a lot of you know stablecoins from a retail point of view. People use USDT, Circle, USDC, and others. But as time is going on and crypto is becoming a little bit more mainstream, there's been discussion around what does it mean for institutional transactions and institutional organizations to start the process of adopting crypto, in particular DeFi solutions. The other question would be, what are the rails that they're going to use as they move forward? So my name is Feroz Sanaulla. I'm a consultant here in the UAE. I've been here about 18 years, quite involved with some of the Web3 related activities here. And I'm going to, one by one, pass it on for my colleagues to introduce themselves. So Raj.
Thanks, Feroz. My name is Raj. I'm the CEO and founder of TransFi. TransFi does cross-border transfers on stablecoin rails, so fiat to stable, stables to fiat, and fiat to fiat on a stable sandwich across nearly 70 countries, one integration, 2,000 nodes across the world. That's what we do.
Hi, good afternoon. My name is Saeed Al Darmaki. I co-founded the first regulated crypto VC fund back in 2017, and I've been an angel investor in the space since then. I angel invested in more than 200 crypto startups over the last 8 years in many different use cases across many different blockchain networks. And I've been fully focused on digital assets for the last 8 years. And I'm even more excited about this space over the next 8 years because I think the rate of development is accelerating. And I think stablecoins is the first real use case of tokenizing assets, tokenizing real fiat currencies. And I think there's still scope for a lot more tokenization of real estate, commodities. Gold is already there, it's tokenized. And just been an advocate of builders on the space over the last 8 years and looking forward to the conversation here.
Hello, my name is Tristan. My day-to-day responsibility is to help institutions make smart decisions about where to invest in digital technology, predominantly banks in this region. I also work with fintechs. The challenge in that kind of role is to be able to look over the hill and understand what's coming and get the bet right. So I think in that context, there's obviously been quite a long-standing movement behind crypto and more so now an interest in stablecoin. I have my challenges in convincing clients when and how to go about that, so it's not straightforward. I think I would assume the vast majority of the audience here are enthusiasts rather than skeptics. And so what I will do is also describe the complexity and the challenge of investing in early stage technology and new rails, new operating models, and whether or not that's likely to be successful. Also, a bit of a realism in terms of timelines and how long these types of changes usually take in order to become sufficient to be self-sustaining.
Hi, everyone. My name is William. I'm the CEO and founder of Altuva Group. My background is actually very traditional finance. I spent most of my career doing something called special situations at a company called Oaktree. And then more recently, what we're trying to do from a business perspective is we're trying to bring or combine TradFi elements with the digital world. And so from what we do at Altuva is our thesis is pretty simple. Most companies don't actually outperform Bitcoin from an IRR perspective. Likewise, any asset class that you actually look at right now, there's a lot of risk that you have to go and take in terms of idiosyncratic risk, business risk, execution risk, leverage, 4 years of your life, and in a good case, in a PE deal, you might make 20% lever return. You're nowhere even close to the unlevered return of Bitcoin, which has done 40% through the cycle IRR. And so what we do is we basically buy undervalued public companies that are underperforming, and then we effectively rescue that capital that's trapped on their balance sheet and within the company itself, and then flip it, and then use the proceeds to go and buy Bitcoin, where we then store it long-term in a permanent vehicle. Ultimately, the goal here is to try to be the first capital recycler of the public markets, turning bad capital into productive capital.
Thank you, William. So as you can see, we have people who are stablecoin natives to believers in startups to realists like Tristan and myself, actually. And then, of course, William, who's going all in Bitcoin. So it's an interesting mix of people. So the question I have for all of you, and perhaps we can just go along the way, is, look, from a retail perspective, we all know how the journey of crypto has taken, and it's testament to a lot of the community that has been built around of how you guys are all involved in the crypto ecosystem. Over a period of time, people have thought about how to get engaged in this ecosystem of DeFi and Web3, and people like BlackRock and others are also getting into this from a perspective of an institutional alignment. Now, that's a big leap, right? Going from a retail to an institutional point of view. So the question to all of you guys is, as the institutions start understanding this technology, would you be able to share with us one or two use cases where crypto, and particularly digital assets and stablecoins, make sense from an institutional point of view? Raj, perhaps we could just go across.
Yeah, sure. So I think I will. So what we do is largely serve institutions, which means remittances businesses, EMI institutions, payment gateways, HR outsourcing firms. These are the kinds of institutions that we serve, and they use our rails, and that's what the primary customer is. But as of now, the business model tends to be more B2B2C. So the use cases that we see is a lot of instances where there is payout happening in stables to freelancers, employees, etc., and that's a big chunk of the volumes that we serve. So the end user tends to be somebody who values stables, but we are going to them via institutions. We can't go to them directly as a retail investor, as a retail user. And the other kind of use cases we see is where businesses want settlements in stable coins. So tech shops, design shops, any kind of cross-border players who are essentially open to receiving value in stable coins. They don't want to receive value in fiat, or the traditional ways of receiving money blocks their money for a longer period in time. Like Visa might block you for 3 days, or a Western Union transaction might block you for 3 to 4 hours. And they're actually looking for faster settlements on stable coins. So that's the other use case that we see, where again, our target customer is essentially an institution, but the underlying use case is always of a smaller merchant, smaller businesses.
Yeah.
That's where we see the market currently. We talk about institutions, pure big, like an Apple or an SAP using stablecoins. I think that's still some distance away. We haven't seen trends of that as of now.
Got it.
I think for me, what's been really interesting to see in the market is JP Morgan actually saying they're going to service clients and use and have their own stablecoin. I think, it's no surprise that the biggest asset managers are fully into crypto. BlackRock, Fidelity. Now you had more recently Vanguard that came into the market and allowing their clients to get exposure to crypto. So I think they're seeing the volume of stablecoins too, the issuance of stablecoin. I think last I checked, it's almost $300 billion across all the different stablecoins that are out there, which is not a small amount. So the big institutions are seeing this, especially the big banks are seeing their deposits as well shrinking, and their clients asking them, we want to have exposure to crypto. We want to have our US dollars in our bank accounts converted to USDT or USDC, and then being able to kind of get exposure to crypto. So I think over the last few years, you've seen the ETFs coming up as well. You've seen the treasury companies like Strategy coming in. So there's a lot of demand from clients towards big banks and institutions to have exposure to this asset class. So I think this area is only going to grow much, much bigger, especially with the big banks really like taking exposure to this and learning how to use it as a tech.
That's a really good handoff because I think, in fairness, what you see is that in order for the use cases, which at an economic level, there are really two primary benefits. There's treasury efficiency and cost avoidance, and then there's speed as the key paybacks that can potentially take place. What so far seems the most logical case is that at an institutional level, it's about having some kind of closed loop payment system, payment infrastructure. Of course, with the largest global bank being JP Morgan deciding to start to build out their own infrastructure, they have the network effect already in place to potentially make that work. And I think that's you can see that they would have the ability to service specific client needs effectively. I guess we're still in that stage where, as an option, either for payment or for a store of value, crypto and stable coin has gone past the point of being something you could ignore, but it's not quite clear how it necessarily works for all. And I think the friction that currently exists in terms of adoption, in terms of standardization, in terms of reliability, is the primary headwind. And that is not quite clear how that will get resolved. I would suggest that the forcing function will be twofold. It could potentially be regulatory action. And as we're aware, there's already a progressed test case in the UAE with its own central bank digital currency. So I think there's that aspect, and then the second part is whether or not there are kind of coalitions of organizations who decide that they want this kind of payment vehicle and mechanism for themselves.
Got it.
Yeah, so look, I agree. I think it is still early days. I think are seeing institutions do some sort of adoption across. It's effectively experiments at this time, and they'll have their own processes and their own routine that they need to go through before that actually is adopted. To me, I think what's probably the more interesting part is businesses, just like people, right? You have to actually go and make payments, and a lot of those payments right now are just on legacy systems and legacy processes and legacy timelines, where I think with the rise of stable coins, you could actually get into that process a much better speed, delivery, and ability to actually make payments. Just like how I think for a lot of people on the personal side of things, right? People are now starting to use stable coins to go and settle payments or transfers and so forth across borders. I think eventually we'll see something similar on the business side as well.
Mm-hmm. So, William, let me kind of follow up on that. So, obviously, the two concepts that we talked about were speed and efficiency, right? Cost efficiency or whatever. So, obviously, it makes sense in the treasury world where you can do settlements faster. You can do intraday settlements, etc. That makes things much more speedy. But we don't talk about risks, right? And do you see any risks in this, and in particular, your business model, where you are unlocking assets there where their tradable value is, a lot kind of lower than the book value or whatever, and the delta that you're putting it into Bitcoin. And we all know that Bitcoin goes through volatility. In your mind, how do you manage that risk, or do you ignore that for the pure viewpoint that if you zoom back out, Bitcoin is only going up? And that's an argument I hear a lot, right? Is that, hey, don't look at Bitcoin today, zoom back. And dude, everything zooming back looks up, right? Anyway, right?
Yeah. No, it's a really good question. Look, you have to start with probably how you define risk.
Yeah.
Right. Volatility of a price to me doesn't equal the same thing as risk.
Okay.
If you think about any type of investing, right, whenever you're doing an investment, right, what are the actual risks? You're going to be taking business risks. You have to go and underwrite the management ability. You have to look at the earnings and make sure that it doesn't drop off. You have to underwrite the competition. You have to put on leverage, right? There's so many different risks, right? Those are real risks that can actually affect the price of your investment permanently. Now, Bitcoin, to me, is the complete opposite. It actually doesn't have a lot of the idiosyncratic risks that you would see with any other type of investment. It doesn't have a management team who's going to quit and be on Twitter every day. It doesn't have earnings that's going to drop off, right? It doesn't have some sort of business risk or competition that's going to rise and affect it, right? What it does come from is that it has volatility, right? But that volatility is actually incredibly predictable, right? If you look at the price of Bitcoin, it follows a very regular boom-bust cycle where effectively people become very optimistic about it. They start buying a lot, you get a huge price increase, and then there's a crash, right, after that excess happens. But that cycle is actually quite predictable, and not just Bitcoin, right? There's a lot of asset classes that demonstrate some similar cycle, right, in the course of history. And so for us, from a risk perspective, Bitcoin is actually the least risky asset in the entire world. Very predictable. The downside is that the actual everyday price can go down for a period. But generally, if you're investing in any commodity, it's always going to be cyclical, right? And the rule here is you don't use leverage, you don't have high OPEX, right? And if you can do those two things really well, right, you can actually get the benefit of the higher returns that come with the volatility.
Got it.
So that's how we think about it.
No, that's a very interesting point you bring up, because the question would have been, why would you not use stablecoins instead of Bitcoin? And you've just answered the question, because a stablecoin is pinned on to a particular fiat asset, and they also have a inflationary problem, which Bitcoin thankfully doesn't, right? So I think I get where you're coming from with your thinking. But Tristan, you're an advisor to large corporations. Yeah, you're my peer and friend.
I have to say, I thought William's arguments were very interesting, but the question, as we know, if you've been in investment management, past performance is no predictor of future return, for one. And for two, I think there's also the aspect of, which is more problematic, which is how do you actually value Bitcoin? Whereas most other assets have some correlation to either a commodity or a business or an income stream, etc. So I think it is quite a unique item, and we're still coming to terms with how that should be priced. And therein, yes, of course, I mean, very few things have got a one-way trajectory, and there's a cycle, and that's kind of natural. I guess what I'm seeing more and more, and echoing what Saeed said, is that realistically there is, let's call it, institutional and retail appetite to participate in what is seen, as Williams correctly said, an asset class that has performed particularly well. And so, and again, Saeed pointed it out too, the issue is, look, historically, and I'll speak for the case of banks, banks in this market have made a lot of money because usually they held on to your cash deposits. They paid you nothing, and they lent it out. And we've got some of the best cost-to-income ratios for banks in the whole world around this region. Overlay, Islamic banking, and that only compounds further. So I think what you have is a situation where now all of a sudden a certain amount of individuals are starting to say, well, hang on a minute. Well, my money's not doing particularly well. Yes, there's inflationary impact. Yes, there are other elements. I want to be able to participate in what is seemingly making other people quite wealthy. And so I think what you're having is now the institutions asking themselves more, what is the cost of non-participation, rather than what's the upside of being in the game. And so the bank I used to work for recently, Rackbank, have now got the ability to do direct crypto investing. I suspect that's really more of a trend that over a certain period, there'll be a reasonable proportion of the banks by market share, which will offer that. So I think we should anticipate that the rapprochement between institutions and the DeFi world will naturally start to close the gap.
Saeed,
I
what's
think,
your view?
yeah, I think the last analysis I saw about Bitcoin was that it's closely correlated to big tech companies. So that kind of risk appetite when it comes to inherent market risk of Bitcoin. But I think with stable coins, you're seeing people who are within the crypto space who are actively trading, actively doing transactions. They need something that is stable because they're already taking on a high amount of risk in crypto assets. So when they want to take out profits, they probably want to be in a stable coin rather than withdrawing it into a bank and then when they want to come back in, depositing it back into a bank. So it removes that friction. I think tokenization in general, whether it's fiat or whether it's real estate or whether it's gold, it removes not just kind of friction, it removes cost as well, it removes middlemen. You talked about speed of settlement and so on. So for example, I don't know if many people know this, but there is BlackRock is backing a company called Securitize. They have a fund which is T-bills, which is called Biddle Fund. I think it's like a few $billions now. And you can actually have exposure to T-bills and go from a T-bill to crypto on a DeFi platform through Avalanche and other blockchain networks. So I think the gap between traditional finance and decentralized finance is getting smaller and smaller, especially as you have these use cases which actually institutions can now safely feel that they can adopt and they can use that tech that's already there to kind of do their business. But I think over the next few years, the tech is yet to develop a hell of a lot more so that actually the level of general population in the world is adopting crypto. So that's yet to come. I think mainstream adoption is still 5 to 10 years away. And it's also related to the platforms and decentralized applications and solutions that are out there, and if they are at a level which is suitable enough for institutions to get involved in.
So Raj, you talk about helping small businesses. When do you think we'll get to a point where it's almost like a push button exercise? Because I think some of the big areas of or gaps are that crypto is still very cryptic, right? People still find it, what is this and how do I play with it? At an institutional level, I'm not talking about people here who are, natives in many ways. When do you make that into more of a push button exercise where everything else under the hood you take care of and the consumer or the SME sees only a smooth, efficient, and fast transaction?
I think the fast transaction, the speed of transaction, the predictability of transaction is already there. I think
Okay.
the issue is slightly different. The issue is around if I don't know something, I'm just not confident about it. And money movement is a business of trust.
Yeah.
So it is not going to happen in a jiffy. It is going to take time for trust to be built into this because that's the essence of money and money movement. So I don't even, I'm not going to argue that things will happen tomorrow. No,
Yeah.
it is happening. It's a secular trend and will keep happening. But I'll just make one point, which is that when I was in college in India, I would go stand in the queue in front of a bank, collect cash and call that as money. Today, I sit in front of my screen and I see a number written on the portal of my bank and I call that as money. That's the transition which has happened. The next transition is that whatever you see over there, which is the messaging protocol, that will change into an asset transfer protocol, which is a stable coin.
Yeah.
I would argue that's a simpler transition than cash to that. That's the argument I would make. But essentially it comes down to trust. This is a business of trust.
Yeah.
It'll take whatever time it'll take. But I'll argue it's a secular trend and we're headed in that direction.
Got it. Look, so let's take that argument one layer further, right? If it's a small business that wants to pay its employees or wants to do a B2B transaction, a few $100,000, perhaps $1 million, fine. Large institutions do bilateral trades in hundreds of millions of dollars, right? And therein lies the concept of that fear, right? Or trust, as you call it, right? So moving money from a Citibank account and settling it in Abu Dhabi at FAB, for instance, right, happens through institutional rails, very much SWIFT focused, etc. And clearances happen through a trusted network. The question is, and to all of you, is when do we reach a point where 100 million, 200 million, $1 billion moves swiftly through a system? And here I'm not talking about circumventing anything, but creating an alternative pathway, a decentralized blockchain-related pathway for the same transaction to happen. And I'm with you. It does take time, but is it a 5-year issue? Is it a 10-year issue, or is it a never issue? And that's really what I want to debate. Anyone? I mean, it doesn't matter. Raj, you can start, and then maybe.
So here's my 2 cents on it. I think first of all, I'm not a soothsayer, so I'm not going to argue what time frame. The question is, what will make billions of dollars of hundreds of billions of dollars of transactions to happen on these rails? And in my view, the bottleneck is around fiat to stables conversion, as we call it. Right? Now, it's much easier to do on the US dollar side because there is native minting, which is possible. The friction, at least that we see, is when you have to do a transaction which is a USDC or USD into a non-USD currency or non-G3 currency. That's where there isn't liquidity. The bid-ask spreads are very high, and that makes and the transactions therefore cannot happen faster. So essentially, the way we see is that the world will evolve into maybe 10, 12 major currencies, which will all get tokenized. They will have their own native minting capabilities. The swap between 2 currencies will happen on chain, and that will then make billions of dollars of transactions to happen. So I'm actually delighted that the UAE government is pursuing its digital dirham agenda, and I would love to see more geographies do this, because that would let institutions be more comfortable, and the volume of transactions to increase. But just one last point, right? I used to be a partner at McKinsey, and I used to run McKinsey's practice on payments across Asia Pacific. And I was doing once a project with one of the largest banks in the world, and our entire project was around how do banks make money? And I thought, wow, this bank has so many branches, does this corporate business, so most of the profits would be coming from the corporate business or the retail business. The reality was most profits came from float.
Got it.
So what you say is it's a very trusted rail for large institutions. The reality is that banks sit on huge amounts of float because of that. It's actually a very expensive way of earning that trust, right? And I think some of these questions will come to bear as we go along.
And that's a very good question, because that float effectively disappears, right?
Absolutely. Because it's also the promise of stablecoins is speed of transactions and predictability of transactions.
Got it.
I thought it was just, sorry, I thought it's an excellent question, Feroz, if I may, because the big unknown really is the stress test of, you were talking about an order of magnitude or 10 or several order of magnitudes difference in size of transaction. Well, of course, with size of transaction comes size of consequence if that transaction somehow fails and the system can't recover it. So I think at its heart, what is complicated is knowing, well, who does the liability sit with in this evolving new infrastructure at the point of failure? Now, what, of course, the argument is, yes, but it's technology. Yes, it's been hardened and proven through so many different aspects. But the example you gave of a Citibank to a FAB payment, and you gave those names not because of who they are, but because of, yes, but if something goes wrong, there's a real institution with real accountability in a real jurisdiction where I will have some form of ability to prosecute my remediation. So I think it's in that aspect that the complexity lies, because the decentralized finance system ultimately disaggregates accountability and doesn't necessarily make it so straightforward if you're the claimant to have a path of escalation, a path for remediation. So that aspect, which sometimes gets criticized, because yeah, it comes with friction, it comes with cost of flow, it comes with institutions commanding the way that things work, also has an insurance benefit. So for me, the question gets answered in, at some point, how does that how do these alternative rails, how does this alternative option become bona fide and guaranteed? And that's why potentially it's a JP Morgan or it's a supranational entity who becomes the underwriter of the system. And that would, if that hypothesis is true, well, you can already predict who's going to be the winner. And I would argue that puts it, the slope is incredibly steep for challengers to be the winners. It will be the incumbents who retain that power.
Yeah.
Yeah, further to what Raj was saying about trust, I think not many people realize that blockchain technology or blockchain network is a trustless network. But you were right about what you were saying. Like, there usually is a centralized entity that's running a protocol. So, for example, USDT, Tether stablecoin, they have been questioned many, many times over the last 8 years as to the legitimacy of is their network, is their processes on blockchain technology, is it correct, is it verified? So when it comes to blockchain and the network and transactions on the network, you don't need to trust it. You know everything is going to run according to a code that can't be changed. But then people are questioning the issuers of stablecoins here, if you like. So when it comes to somebody would probably prefer to have a stablecoin that's backed by JP Morgan rather than USDT.
Yeah.
So then when you have more options on the table, especially institutionally recognized options, that's when you're really going to see a mass volume of liquidity coming from traditional markets into digital asset markets. And I love what William's doing with his kind of startup. It is basically trying to get money that's sitting there and not kind of benefiting neither the existing owners of the company or anybody else or the shareholders, and converting that into Bitcoin, which is an asset class that has been proven over the last 16, 17 years to return 30% year on year.
Yeah.
So when you have institutions giving the customers options and you're leveraging blockchain technology, I think there's a big future there and there's a big market there, and established capital markets, it's almost $250 billion, which is $1,000 trillion. Once you start seeing some of that liquidity flow into digital assets and the trust in that space go up, then there's going to be a hell of a lot more activities, a hell of a lot more transactions. Then you're going to start seeing billions moving across borders without any issues.
And William, that's a segue to you. Is that so? You now, let's say you're an accumulator, right? So you're going to accumulate Bitcoin, but today Bitcoin is priced as what? A US dollar or euro or whatever, right? Bitcoin is not on itself a measure, right? So a world could come where I would say $1 equals X Bitcoin, right? Rather than 1 Bitcoin equals X dollars, right? Because it could flip. And the reason it doesn't is because, as you rightfully said, $250 billion work through a fiat system, and hence you compare it to a fiat at this point in time. So all that locked value at some point in time, your investors or your stakeholders will want to liquidate, right? At some point in time. And they will liquidate it into usable fiat, unless Bitcoin itself becomes fiat-like. Do you think that at some point in time, Bitcoin will head towards a fiat-like world, or there will be chains that would be, level 2 or level 3 chains that will make it almost like, everybody started experimenting using Bitcoin to, as a form of currency, but I mean, we're not there yet, right? So what's your end game? What is your end game with your asset that you collect and accumulate?
Yeah, so look, I don't believe that Bitcoin will ever be used as a good transaction method. The evidence highly suggests the opposite.
Yeah.
But I do believe that it's a great store of value,
Yeah.
especially if you hold it through the cycle long term.
Yeah.
Now, to your point, what we are doing to go and fix that issue, right, is we hold the Bitcoin not in an LPGP structure, right, where that has a defined life and you've got to return capital at the wrong time, and if you return at the wrong time, oh no, right? What we do is actually we hold it in a public vehicle on the balance sheet without any leverage and with very, very little OPEX. And we hold it there permanently. Right? And so the shareholders or the owners of that Bitcoin are actually shareholders in the company itself, right? And effectively they have a stake in that Bitcoin, right? But the actual Bitcoin itself stays there permanently as a capital base in that public entity. So, the shareholders can exit whenever they want. They can obviously transfer to USD, right? USD is clearly the dominant form of a transaction currency. But the way we've structured it is unlike an LPGP structure where you have to go and return capital after a certain amount of time, right? We have a structure that's permanent in nature, that doesn't have any leverage, that doesn't have much OPEX. And then probably even more importantly is that in that structure, because of everything we do, right, it's all accretive. Right? We actually increase our NAV per share every time we do a transaction, right? Because we're buying things below value. And so over time in this structure, what happens very interestingly is that your shares actually start trading at a premium, right? Because you increase NAV per share, you should trade at a premium. And so the other side effect or benefit of using this structure is unlike in a cash on cash model where if I make an investment, I have to pay $1 for 50 cents. Here, I can actually buy 50 cents using currency that's actually priced at a premium to my NAV, right? And therefore, it's actually becomes much more creative for me to actually do this type of transaction.
Yeah, I mean, the whole NAV concept goes away, right? Because what is NAV for you?
Well, this is the
depending on when your LP wants to exit, that's their NAV, right?
Well, in a normal company, NAV is effectively the assets on the balance sheet, right? And obviously, there's a lot of different NAV, and every company NAV is different. But in our process, what's really interesting is after we buy the company, we actually convert their NAV into our NAV.
Yes.
Right, through this process of selling off everything and buying Bitcoin, right? And so when we do that, we can actually, if we're taking advantage of the fact that we're buying something below NAV, using stock that trades above NAV, and then we convert their NAV into our NAV, then all it remains is just a pure price arbitrage.
Yeah.
Right.
Got it.
And so it's quite accretive and cumulative from that perspective.
Got it.
To answer your question, Feroz, about will Bitcoin kind of replace fiat at some point? Will everything be priced in Bitcoin at one day, or will it still be priced in fiat? I think the next 20 to 50 years is going to determine that. I think it's going to take a long time for most of
the supply will be exhausted by then, right? So 2035 or something like that.
A lot of governments are going to go bankrupt and stuff.
Yeah. Keeps reducing with, I think, 21 something.
Is right. Now it's gone to 21 something. Okay.
I think, Feroz, if I may, I think you were starting to trend into potentially politically hot waters, which is whether or not cryptocurrencies can accelerate the potential erosion of having a world reserve currency. And I think that is actually a much more complex and potentially high impact scenario, which arguably there are signs that there's enough of a coalition of interested nations that would wish to have an alternative to the dollar. Now, does that mean that they have to create their own, or does that mean that there's a format of a stable coin that fills the gap? I think that's probably ultimately what would be like a steroid injection and more to this entire ecosystem.
Fair enough. And I think in some ways if I were to kind of delve a little bit into politics, one might say Bitcoin actually suits a failed economy much better than it suits a, for running economy. And yet, US is one of the largest uh, asset holders of Bitcoin, right? So it's interesting to see how the dichotomy actually works. But let's shift gears a little bit and talk a little bit about regional concepts. And William, bear with us for a little bit. Perhaps this might be new to you, but there are many instances of stablecoins being developed here. And I would dare say that from a technological and from an innovation point of view, UAE has literally taken the world by storm in terms of innovation in this space. Um, Raj, is the market big enough for us to have 3 or 4 instances of stablecoins? And if not, is it going to ultimately gravitate towards the e-dirham and that becomes the CBDC of choice?
I don't know if it'll be CBDC or not, but I think 4 is probably a bit too many. I think you need liquidity in this. And I think one good digital dirham is good enough, probably, in my view.
Mhm.
What is critical is liquidity. And I
Yeah.
think too many is probably not the right answer.
Yeah.
When it comes to the UAE, I think in general, when it comes to emerging technologies, you look at blockchain, the UAE was one of the first kind of open supporters of blockchain technology. Today, you have AI. A lot of money is being put into the AI
Yeah.
structure, into AI infrastructure as well, and you're seeing money being put into blockchain infrastructure too. So with UAE, I think when anything which is emerging technology or new, they want to be the best at it. They want to be the first to market at it.
Yep.
And it's no different with crypto, and it's coming from the top down rather than the bottom up. So I think it's
Yeah.
really important.
But don't you know don't negate yourself, Saeed. You were one of the first from the bottoms up who got into this business when the tops didn't even know what the hell they were doing, right? So in reality, I'll tell you that a lot of the population here got into this business early.
Yeah, I mean, back in 2017, when I left ADIA, I used to be in Abu Dhabi Investment Authority for 9 years. And when I left ADIA at the time, most of my ex-colleagues would ask me, why are you
What are you
leaving?
doing?
Why are you resigning? And I said, because of Bitcoin and blockchain and crypto. And they're like, you're crazy. Like, you're leaving one of the best paying jobs and best career paths in the world to go into something that's unproven. But in 2017, even in the UAE, it was still very new.
Yeah.
But now half of the people that I used to work with, they call me up and they say, hey, what is this blockchain? What is this crypto?
Yeah.
How do we get into it? So I've gone from crazy and it's full tilt circle into you actually know what you're doing.
Yeah.
But I think the UAE has come a long way
Yeah.
in this space, and I'm happy to see it.
Any comments, Tristan, before we start closing down?
Look, this nation is fascinating for its ability to be forward-looking and deliver on it. I was having a conversation with one of the panelists just before coming up here about the ongoing demise of the West. So that's, I think, what you have in terms of scale. Yeah, look, it's a small market, right? It's unrealistic that there should be more than one stable coin. I don't see that anybody appreciates complexity. And so we're in that natural cycle of innovation where you have proliferation. And after proliferation comes consolidation.
Yeah.
So let's just wait to see that play out.
Got it. Okay. Good. Any parting thoughts, or should I open it up for any questions? Maybe we've got 1 minute. Anybody has any questions? No questions allowed. Okay. I've been told that we got to be on time, and we need to. So, any parting thoughts, William? And we'll just walk this way.
Yeah, look, I think to me, it's still a question mark on whether the US is a successful or failing economy.
Yeah.
I mean, if you look at the US from an expenditure perspective, from a debt perspective, I mean, it's effectively the most poorly run business you've ever seen. They're printing 8% new money supply every year. And the debt is literally on an exponential growth path, where there's no option at this point but to print more. Yeah, look, I think cryptocurrencies, Bitcoin, whether it's Bitcoin or stablecoins, will play an increasing role over the course of the next 5 to 10 years. Most of the debt has been printed in the last couple of years, and yeah, I think we're in for some really interesting times.
Justin?
I would agree that there are some material issues with the fiat system, and something will need to change. How it plays out, I can't say, but this is definitely part of what comes next.
For me, I think Bitcoin and digital assets are the best hedge against a flawed, failing monetary system. And over time, as it grows in market cap and has less volatility, then it will become more and more sound money and more trusted as a store of value. And there's a lot more developments that are going to come over the next 5 to 10 years.
Raj?
Oh, I would like companies like JP Morgan to win as stablecoins get mainstream. I would just want them to acquire companies like TransFi along the way.
Thank you. Well, thank you very much for attending. Thank you for the panel. And we are here if you want to have a chat with us. Thank you.